How's everybody? Good.
I wasn't loud enough.
Oh, I know. I'm a mom.
Really.
My voice can carry.
Me too. I'm not a mom, but
Yeah.
my voice can
Yes.
Well, yeah. So, give a couple more minutes for people to trickle in. But if you haven't signed in, you gotta make sure to do that. But all good. I appreciate everyone coming out. Hope everyone's been excited. It's been a amazing journey to create this event, and hoping everyone learns a lot. It's gonna be a good time. But yeah. So I guess we'll start in a few minutes. We're good with sign-ins and whatnot.
Yes.
Cool. Ready to go? All right. Cool. So yeah, thanks for.
Yes.
A lot of forms to be signed.
Forms, man. Paperwork.
You better live up to
one
this.
more. Sweet. So yeah, thanks to everyone for coming out today. We will be navigating the crazy or evolving real estate market that everyone's probably been reading about in the news. Definitely not the same as it was a year ago, and a lot of changes have been going on. But we luckily have some of the experts in the industry to help us navigate and understand what's going on. So it's going to be a great experience for learning. But to start, could we just all introduce yourselves? Maybe starting with John.
Sure. Well, thank you for having me. I hope we have a fun night together and you take something away from it. My name is John Payne. I am the president of VICI Properties. VICI is a real estate investment trust. We're based in New York City, but I happen to live 2 minutes away. I refused to move to New York when we started the company 5 years ago. We'll get into a little bit more detail about what we do, but we own what we would describe as experiential real estate and lease it back to operators. We specialize in the casino business, and we'll probably get into a little bit of details on that. Thanks for having me.
Yeah, definitely. If you want to mention it, a couple words. What kind of properties, or what are the properties that you own?
We own a few small assets. We're the largest real estate owner in Las Vegas. We own assets that you all might know, like Caesar's Palace, the Venetian, MGM Grand, Mandalay Bay, a few others that we own. New York, the Luxor. So we have 10 assets in Las Vegas, and we lease them back to world-class operators.
Great, and I'm sure some of the audience is familiar with. I
heard some shaking of the heads. Most probably have the sports book app on there. Yeah, got it.
Great.
All right, good. Hi, everybody. Tara Hernandez. I wear a couple hats. So the first one is I'm a real estate developer and also do real estate brokerage. But the other half of my life, I run a tech investment fund. So we invest in early to late stage tech companies. So I think that's going to integrate today, and happy to, looking forward to the conversation.
Guys, my name is Cullen Momus. I am Managing Director of North Companies. We originally branded as New Orleans Development in 2013. We started the company with three of us. We were actually Tulane alums. I met them at a Freeman Days event, we started with the thought of developing projects and properties in and around kind of some of the infrastructure and investment that was happening in Mid-City. So we've started some small funds, friends and family. We've grown the company over about a 10-year period now. We really focus on historic tax credits primarily, and we overlap tax advantage strategies. And right now, what we're focused on is investing in opportunity zones. So for the last 3 or 4 years, we've been focused on opportunity zone investing, and something I'm happy to share a little bit more as we go.
Great. So I'm Ben Malik. Joe Sulu and I founded the Real Estate Power Players group here at Tulane last year, and it's been growing very rapidly, and we appreciate everyone who's joined and has come out, and anyone who hasn't joined yet, it's be a great time to do so. But yeah, a little bit of background about me. I've been interested in real estate for quite a while. Mom is an attorney, does real estate transactions, so kind of grew up around it, reading loan docs when I was 10 because for some reason I thought that would be a good idea. And yeah, just as I've grown up, my interest in investments has brought me closer into real estate, and it's been a great journey. And realizing that networking is a big part of the industry and meeting the people that we're going to do deals with in the future. It's great to have this opportunity to meet all of you and build relationships and learn from each other and share best practices and whatnot. So I'm very excited to do all that. I'm also the host of the Real Estate Milestones podcast, which is on all platforms around there, but we learn about real estate. It's a journey through commercial real estate, try to figure out what's going on in the industry and how you can get involved. So I like to ask each of the panelists one of the questions that is always asked on the podcast, which is, what was your first milestone in real estate?
Wow. Well, when I was in college, I literally got my license, and I started and jumped in there. So I always knew early on that I wanted to participate in some way.
Well, it's important to know I'm not a long-term real estate executive. I think that's, I come from a little bit of a different background. I spent 23 years in the casino business. So I came out real estate from an operator's perspective. And I worked for a company called Caesars Entertainment that had one of its subsidiaries go bankrupt. And what happened in that bankruptcy is that subsidiary split. And the operations went back to the operator, and a new real estate investment trust called VICI was formed in October of 17. So really, my beginning just started a little over 5 years ago. And the first deal I did was we bought a casino called Harrah's Las Vegas 30 days after we started the company.
Great.
For myself, my first project, or first two projects, actually brought me to Tulane. It was 2007, 2008. I'm born and raised in New Orleans, moved back to New Orleans following Hurricane Katrina. I really wanted to help my family, but felt the city was kind of part of my family as well. Just wanted to come back and rebuild. I was on my second duplex that I was renovating right down the street in 2008, and I was going into the bank to finish my last draw. And the banker at Hibernia at the time, which got brought into Capital One, told me, said, look, I don't know what's coming down the pipe, but something bad's happening. He's like, I can't give you this loan just to pay. It was a small signature loan to pay our contractor so he can get his money early. He goes, you're going to have to go through the whole process and just wait a few weeks. But in the future, I'm telling you now, something bad's coming. And so this was the first thing I realized, like, well, that's going to be interesting. And within 3 weeks, I mean, capital markets were locked up. Luckily, I was on the back end of my project, so I knew that, I wasn't left in a situation where I couldn't even draw the rest of my construction loan. But I realized at that point that I had a passion for doing real estate development, and I wanted to go back to school and really, figure out how to put larger projects together. So for me, the smaller projects just like that, I saw kind of the good, the bad, and ugly really quickly, and it really made me want to come back to school and figure things out.
Great. And before we get into the market and what's going on in the current environment, could you guys each just give us a little bit of background of what your companies do and what you do within real estate?
You want to start?
Sure, I'll have to start. So I mentioned earlier opportunity zones. Really, it's our focus over the last 3 or 4 years. So when individuals create a capital gain, they can sell investment property, they can sell stocks or bonds, they can sell a baseball card collection. It doesn't matter what they do. If they generate a capital gain, we know that you're going to have to pay a capital gain tax. So what these individuals do, they say, look, I really don't want to pay my capital gain tax this year. I'd like to maybe reinvest it and see if I can defer my capital gain, and then at some point, have tax benefits in the long run. So there are opportunity zone funds. It was created in the Jobs and Tax Act of 2017, where you can take a capital gain, you can invest it with an opportunity zone fund. That opportunity zone fund then takes your capital and goes invested into certain geographical districts that are set up around the country. And that's what we tend to do. We take opportunity zone investments and we go invest those into the zones. Typically, those zones run similar to low-income housing census tracts, but not always. They were dictated by the governors of each state. And what we do, we look for distressed properties in these communities, and we look for the ability to kind of have transformative, catalytic projects. We can come in, typically look for assets that are blighted or distressed, and that we can come in, acquire, completely redevelop. We typically use historic tax credits where we can to try to renovate projects, and we look for an overlap where we're able to marry those two programs together. Again, we've been doing this for about 4 years. The interesting thing is, you have to hold a property for 10 years, or an investment for 10 years in the opportunity zones in order for you to realize the full benefit of the investment. And so for us, it's really a long-term investment in a partnership with a lot of the communities that we're in. So when we're going and investing in locations, it's not necessarily just looking at an asset. We're really getting to know the local people, the local government, the local business community, and people that live there, to make sure that they understand that we're there for the long haul. And so it's something that we're focused on and we continue to do.
Good explanation. So aside from the brokerage arms, we convert underutilized real estate into cool creative spaces, right? So in and off the downtowns, We look for opportunities similar to what he does. The majority of them have been public-private partnerships, so we have been leading as the catalytic investor to basically transform a neighborhood. And so that, you know, in real estate, there's, in terms of development, is either two things: a use looking for a piece of dirt, or dirt looking for a use, right? It's going to go either way. And so we are usually within those footprints, and I would say near the arts district, near sports stadiums. You know, you want to be on the edge of the cool stuff that's happening and slowly build into, you know, that fringe and build the fringe into it. And so that's our strategic approach. Right now, I'm a part of the development team doing a brand new neighborhood on the riverfront called the River District. So all that vacant land at the end of the convention center on the river, on both sides of Chapatulas, including the power plant, is going to be called the River District. And so we're transforming all of that into everything that a neighborhood should include.
You did a good job putting together a panel that has a very diverse group of what we do.
Right.
Right? I mean, really, this is really good for you all, because many of you probably have said, hey, I want to get into real estate. You're going to see three very different areas of real estate. So, as I stated, I work for a company called VICI Properties. We are a publicly traded company. We are a triple net lease REIT. So we go out and we buy buildings and land and we lease them back in a triple net lease to great operators. So as we said earlier, we own Caesars Palace. There's probably very few people in the world that knows that VICI Properties owns Caesars Palace. Most people believe, who owns Caesars Palace? Caesars, the company, is the tenant that runs it. Okay? That is what we do. We go out and find opportunities to acquire assets and lease them back to operators. Now, we started this in the casino business. We saw this amazing opportunity to institutionalize the casino business, and we've done that pretty rapidly. We've done probably about $30 billion of deals in about 4 years. But we always started the company, we knew it'd be what we call experiential real estate. So not only will we continue to buy casinos, we are in the process of buying things like indoor water parks. You might have heard of Great Wolf Lodges. We just announced a deal with Canyon Ranch. We just announced a deal with a golf developer called Cabot. And so you're going to see VICI over the next decade not only continue to buy casino companies or casino assets and lease them back to companies, you're going to see us diversify into all of these areas. And part of the reason we're doing that is there's only certain states that legalize gambling in the United States. So we can only own real estate in those states. So if we want to own real estate in Texas or Florida or Georgia, we need to diversify into other experiential real estate. And so that's what we do.
Excellent. And so it's very interesting because your company has been started, I guess, 5 years ago or 4 years ago. That's not too long ago to have done as much and own as much as you do. I'm kind of curious, how did VICI come to be? How did that get assembled?
We worked hard. You know, we went out, we as I told you, we started in 17, we went public in 2018, and we've done about $30 billion of deals by just hustling, finding these opportunities where we didn't think the market really understood the value of casinos and casino real estate. And so we've just been very active. Again, I'm an unusual executive in that I've taken an operator's approach. We were talking about this earlier, that I didn't know when I left operations of a casino, would I add any value to a real estate company? And what we found in this space in particular, that the C-suites or the CEOs of companies or the COOs or the presidents who are negotiating deals with me have liked to have someone on the other side that understood what they were trying to solve for. And so we've moved fast. We've had great really support from institutional investors, and that's really how we've grown the company.
Excellent.
And that's important because a lot of times people go or seek to acquire something without understanding, you know, the actual real estate, how it works, how the ops team needs to maneuver. And so if John's looking at property and I'm looking at a casino, he's got a huge head start because he understands how it operates and what works best for them, as opposed to me coming in blindly.
And when you're negotiating a lease, our leases are 300 pages. I'm sure you'd love looking at that.
Yeah.
There are points in the lease that matter to an operator that if you don't know why they matter to the operator, you will stick your heels in the ground and say, well, that's what leases look like. And so we've been a little bit, we should have said, we started this company by saying we're going to be a real estate company based on relationships. That we do not look at each we're not a transactional company. Every time we do a deal with a partner, we hope it leads to another deal. And if any of you have followed our history, that has played out. And it's important. And so there's times we give in on things on leases that other REITs wouldn't do, because we say, look, it's not great for us, but it's important for you, and we think it'll lead to another deal.
Yeah. I've noticed that in the rights of first refusal you have with many of the companies that you negotiate with. So yeah, definitely later on I want to ask a little bit about the lease terms that are in this complex industry. But for Tara, so you create cool and creative assets. I think it's a strong model and very I think indicative of what we like to see in New Orleans. But I'd love to learn a little bit more about your investment philosophy and hear about an example like Blue Plate. Seems like a really interesting development.
Actually, that's a good example because somebody asked me about that earlier today, and so you'll understand. So first of all, we can create new buildings and they're great, but when you have some old bones, right, that you can bring back to life, and so some of them are Blue Plate and the American Can and some others that I've touched. Here, my coolness factor is having you understand that the old was there, but transforming to the new. And how do I do that? There's a story. Everybody loves a story. And the story is taking some of those components of how that old manufacturing facility functioned, and I'll hire a sculptor and they will recreate. And so those pieces are throughout the property. It's branded in the messaging of all the things that we do, whether it be name, whether it be logo, whether it be website. It's all part of the story. And so the example of Blue Plate, they used to make mayonnaise, barbecue sauce, and salad dressing there, right? And my target market, you always know your customer. If you don't know your customer, you won't make the best decisions. It's really important. If I tell you anything, you just know your customer. And if I say I want to do an apartment building, right, this is a little bit of strategy. An apartment building in the suburbs and an apartment building in the warehouse district has totally different customers. Some of them want space. They might want carpet. You better not do that in the warehouse district. You better not do that downtown. And you want the high ceilings. Because it's more expensive, people like their location. So they're okay to sacrifice square footage. But you give them amenities, because they hang out in the kitchen or they hang out in community spaces, that pays, that is a good offset as opposed to what might happen in a suburban context. And so there are all these little nuances. But essentially, if I can't create something that I know I'm going to have a connection with my customer, I'm not going to do my job. And I'm not going to meet whatever my development or financial and otherwise goals are. And so also my customer likes to hang out in the cool spaces, right? And so they want to walk to eat, they want to walk to entertainment, they want to walk to sports, of all these things. It's a lifestyle. It's more of a lifestyle than just a living situation. So that's part of that. Then there's some where I have ground floor retail or I've done independent retail. So our strategy is literally to be in those spaces because my customer will be able to adapt to any of those types of developments. I hope that helps.
Yeah, definitely. And Colin, so first I want to mention that, remind everyone that he's a Tulanean like all of us, so I'd love to hear you touch on your experience with Tulane, but also North is vertically integrated or has their, I guess their fingers in all the different parts of operating and developing and managing real estate. So I want to hear how it's a competitive advantage and how that works in your company.
Oh, great. So going back to what I was saying earlier, I met my two business partners at a Freeman Days event here, and I'd come back to business school. I did my MBA in 2011, 2012, 2013. And so we started the company. They actually had a horrible thesis. They were like, hey, we're going to do this type of asset. We want to do kind of quick rehabs. And I'm like, guys, these type of rehabs aren't going to last 5 years. Like, we need to take the money. We need to invest wisely. These areas are prime for investment. And kind of speaking to what Tara was saying, we knew who our target market was. They were young professionals, people who wanted to be living in the neighborhoods, and they wanted the experience of these houses. And so we really took the time, evolved the thesis, and create these duplex, shotgun duplex homes that were, I'm still proud to this day of all, hundreds some odd duplexes that we put into Mid-City, all around new hospitals, and all the tenants that were incredibly happy. Going kind of to the company, so one of my business partners, Alex Hernandez, is a Tulane alum as well. He is a CEO of Hernandez Consulting and Construction. He and I started with one of our other partners, Mike, North Companies. We were branded New Orleans Redevelopment Fund at the time, and we've since rebranded to North Companies just because we're doing work outside of New Orleans. And so Alex also, through his company, they do large projects, commercial projects, a lot of federal work for construction, and they also own 50% of an architecture firm. So we're not necessarily vertically integrated as much as we are vertically associated. And what it allows us to do, though, it allows us to see projects. We take our construction team, we're able to take our architects to a kind of a target project, and within 2 weeks we can have a pretty well-defined budget, a well-defined plan if it's something that we want to move quickly on. And actually, over the last 4 or 5 years, the frequency of the rate by which you had to put an offer in on a project and actually close, it was actually made me uncomfortable. I mean, we had to acquire projects in instances where we just came up with our number and we had multiple offers on a property, and we had to decide quickly this is something we wanted to do. So from that standpoint, it's been beneficial that we have these groups working together. One challenge when you have a company and you're doing all those things, though, is that when something goes wrong, it's pointing fingers. It's like this. And so our contracts, while we have the contracts between the three companies, I mean, we're really all affiliated, and so it's tough. And so we've had some growing pains over the last decade trying to figure out how to make things work. But in general, it is working. And so we're now expanding to different markets, primarily throughout the Southeast, a few in Texas, Georgia, Florida, Alabama. But that's kind of what we're up to.
I can imagine it helps with sourcing materials, or you have the assumptions of what materials will cost because you have the people who are already doing it, like feeding you the information directly, and just in terms of like integrating between each other, it seems like a powerful, mechanism.
Yeah, it's funny. I know you want to talk about, we're going to talk about kind of budgets and economic drivers in a little bit, but it's funny. Back in I think 2021, we pretty much been doing most of our projects in the 200, 225 range per square foot on renovations, and I got a budget that came across my desk, and one of my project managers brought it to me. It was like $280 a square foot to do this renovation. And I looked at it and said, look, this is great, and I know we're being conservative, but if we're going to start doing projects at $280, we all need to go find another job because we're not going to be able to make this happen. We're not going to be able to do this. Excuse me. We put that project out to bid, and it came back like $500 a square foot. And so that just gets into like kind of where we are as a, I think, in the industry right now in terms of across the board. And just kind of where we are, but it did allow us as a cohesive group to kind of work and value engineer the budget down to where it's a project that we can do, but it's a challenge.
Yeah. So, John, could you tell us a little bit about, well, just intuitively, it seems like entertainment would be somewhat related to COVID, and that might have a impact. But I'm curious, how did COVID interact with the real estate that you work with every day, and then how have we...
You're going to make me go back to this time?
Yeah, maybe we could just touch on it, but I really want to hear how things have evolved since that time and where we are now.
Sure, I'll give you a perspective. Look, we started our company, as I said, in October of 2017. In March of 2020, every casino in the world was closed. In the world was closed, like many businesses. So that's the bad news. The good news, back to being a former operator, is our tenants did not go into COVID with pre-existing conditions. They came into COVID as rich as they've ever been. So VICI was blessed in that we were one of only 2 REITs, publicly traded REITs, that collected 100% of our rent in cash during COVID. because our tenants and our real estate, or I should say our real estate is so valuable to our tenants, they knew they needed to continue to pay for that. If you're a Starbucks, you could build another Starbucks down the street. Back to Caesar's Palace, the likelihood of Caesar's being able to build another Caesar's Palace is not very likely. So you want to keep that lease. So fast forward, we would never want to go through COVID again. I'm sure you all would agree with that. But for our business, it proved out our model. When we started the company and we took it public at 18, we kept being told by investors, well, we don't know what's going to happen in a downturn. What's going to happen to your tenant's business in a downturn? I said, well, what happened when they went zero?
Yep.
And when they went zero, they still paid our rent. And so as we came out of this, our company accelerated. We had greater access to the capital markets and were able to grow even faster because there was a strong belief that our business, our tenants' business, was incredibly durable and its cash flows were durable. And as they came out, they had record earnings at the end in 21 and record earnings in 22. So again, never could have predicted that. In April of 2020, it was not that fun, but in our case, it actually proved out a model, and the operators reinvented their business and are doing well, which means we've been doing okay.
Great. So Cullen, since around that time up until now, how have you seen the market change, especially in New Orleans? How has the progress since that point evolved to the place we are currently?
It's a tough question because I don't know that everything here in New Orleans is just COVID related, or I think that there are a number of issues, and everyone here I think lives in New Orleans primarily, and there are a number of issues that we're facing as a city. I think over the last few years, I think maybe things in the city haven't progressed as much as we want them to, and even on some levels, I'd say some of it's been unacceptable in terms of some of the things that we've been dealing with as citizens of the city. One thing that I see in a lot of the neighborhoods where we were developing, there was a lot of hope, a lot of excitement of things that were to come. There's the Lafitte Greenway, which I still think over time there's a story that's going to be told about this, corridor that's connecting the French Quarter to City Park. And there are a lot of early movers that were buying assets along the Lafitte Greenway, trying to help tell a story about what's going on there and really doing some really cool projects. We were one of them. And then over the last, call it 2 years, things have really stalled out. I think a lot of the momentum that we saw, even call it post-Katrina, I think there was a lot of momentum in the city post-Katrina. And then COVID, I think, really stalled a lot of it. And now, unfortunately, I think we're in a situation where we're facing some tough economic times. And there's significant, when we're talking about, I'm on the multifamily side. There are issues with affordability and housing. And unfortunately, I don't think that, and I'm going to be, let me take a step back. Let me take a step back. As a developer and doing these type of projects, I'm inherently the most optimistic person that I know. I have my partners who sit down with me and are like, man, you just got to stop being so optimistic. We're not going to get this. We're not doing that. I'm like, yeah, we can. We can do that. We can take this building and do X, Y, Z. But I can say right now, I think we are looking at some very serious issues moving forward as a city over the next 2 years. As I was mentioning earlier, we had issues with kind of the economy and inflation on the construction pricing that happened. This really 21 was really where we saw some shock. A lot of the projects that went forward, though, they still bore those costs. Well, I don't think that the full cost of those for rents and everything actually accelerating, the inflation on housing, we've seen it yet. And so I'm concerned what's going to happen in this city over the next year to 2 years on affordability, or if not affordability and rents don't go up, potentially landlords who aren't able to cover notes. I mean, there are a lot of things that are moving right now. Yeah. It's kind of a circular puzzle, and look, I hope it all comes together. Optimistically, I have my family here, and I will be here, and I'm going to fight for the city and do what we need to do, but it's going to be a challenge.
Yeah, just to add to that, I kind of see it as locational is insurance. I don't know, you should be seeing the same stuff we're saying. The insurance is double. 100% increase. The construction costs have two components to it, or maybe three. One is the cost of materials and equipment and the availability of it, and the other is labor, cost and the availability of it. Some of it, in terms of supply chain, is kind of catching up a little bit, but actually having the product to then send through the supply chain is the other issue. So in some places, that lack of availability or the cost is still an issue. The biggest thing is labor, because guess what? People are deciding they don't want to do certain things anymore, right? Or they moved, or whatever the situation is.
Or there's a lot more work in Homa or
Yes.
La Place still, and Florida.
Yeah, with the other places that were impacted with, and there are teams that travel to do that recovery, disaster recovery work. So when everybody's trying to do something at the same time, that is becoming problematic with all the other interest rates, that labor availability, the cost, and insurance. It could totally kill you. And time is, you need to always pay attention to time, because guess what? If a deal takes me 15 months, if a deal takes me 20 months, if a deal takes me 30 months, guess what? I'm getting the same fee. So I want velocity, right? So, there's a couple of things. So you got to be strategic about it. I'm not saying rush and with haste, but you want to be as efficient as you can, because you're going to get paid the same thing regardless.
This is why you put together a very good panel, because they really have these issues they're dealing with labor. And I'm sitting here going, well, shoot, the biggest issue is financing costs.
Yeah.
Right? So just get hit home on financing costs. Yeah, exactly.
We put you on the interest.
Yeah.
Put you on that too.
Yeah, that we're an investment grade company. A year ago, if we wanted to raise 10-year paper, it would have been in the 3s. It would have had a 3 handle. Can anyone guess what it would be today if I wanted to?
Yep.
7.25?
7.25.
To 7.5 in some instances.
As an investment grade company.
Right.
So think if you're a developer right now, and you've now put together a budget a year ago, expecting that you were going to get construction loan at 4, 5, whatever. Well, first of all, if you can get it today, you're lucky, but you're going to get it well into the double digits.
It's killing several deals right now.
So as you think about developing, you have all these factors hitting at once. Can I even get the material? Can I even get the labor? How long is it going to take me? And this is not a New Orleans issue. This is a urban core issue of the United States right now that you're seeing, other than Nashville, Austin.
Some global.
And that's what I was going to say. And the one thing that I'm even more concerned about, 3 years ago, somebody said, hey, there's going to be a global pandemic, it's going to shut the world down. I would have said, look, I would put my life savings, that's not going to happen. I would have lost it all. Well, Caesar's Palace, I would have kind of gambled all. But, so the one thing that I'm really concerned about, you look at the ports and where we're getting a lot of our, materials from. Think about all these Chinese ports. I saw a statistic from an economist. I think out of the top, 20 ports internationally, I think 15 of them are from China. Well, if China continues moving down this kind of zero COVID and there's another lockdown, I can't imagine what's going to happen with prices. Apple
has already said, don't expect as many iPhones because I cannot get my chips from China.
Yeah. So this is a way that's an interesting time for you all. We're not trying to depress you along the way, but it's stuff you need to be thinking about, particularly in real estate, and depending on where what type of business that you get in. And no matter which type of business you're in, you always have issues that you're dealing with at the time. But to me, it's been the velocity of change.
Right.
At least on the financing. Never in anyone's lifetime have we seen rates move this fast and be this volatile. Never in anyone's lifetime. Your parents' lifetime, your grandparents' lifetime. There's never been a time that rates have moved like this. And finally, and you guys know this, we are coming off 15 years of free money.
Exactly.
And so developers, my colleagues to my left, are all learning that the future is going to be very different than the past, and how you think about deals and how you put together deals. And I do think the more creative teams will ultimately be the most successful ones.
I agree, and I was actually thinking about, when I was in school, 2011, 12, 13, we were modeling projects with a professor. I remember we were modeling them at 6.25%, and our cap rates, we were using 7% cap rates, and those are fine. And then I get into the profession, and all of a sudden we saw our first 5 handle on a rate, and I said, man, this is cool. Then I saw our first 4, and I'm like, wow. And then we were doing a project in 2020. Thank God we closed it right before, we closed it March 30th of 2020 at construction level.
Yeah, you were good.
But it was 3.5%. And I was blown away to think about it at the time. And it was free money at the time. And so it's not that we are historically, somewhere we haven't been, but it's the whiplash of how quickly we move to where we are today. And I think you're actually already starting to see it. The private market is pretty small. Okay, you can see with homes. I think when interest rates and mortgage rates started skyrocketing, people were freaking out. We're not going to be able to sell them. Well, now you're starting to see the ARM start to become really famous again. Everybody is buying properties using ARMs because they're betting that interest rates will eventually level off and come back down. Will we see 3.5, 4? I don't know. I doubt it in the next 5 years, but I'm sure things will stabilize. And so, good news is I think the pessimism or some of the concerns is what we've been through, right? And now how quickly things have changed. And then, I believe that things are going to stabilize. Hopefully over the next year, 2 years, we will see stabilization.
But I do think if this is an industry that you want to go in, different than kind of what I used to do running casinos, you have to be on top of capital markets and how things are working constantly because it affects your day-to-day business all the time.
And just to speak to that, we had a construction project that we were supposed to close in October in Tyler, Texas, and it was going to be a conversion of an old hotel. We're converted to 140 units, and we were set to close, and we had a 4.25% interest rate. That's what we were going in at. Well, all of a sudden, rates start going up. Now they're at 5%, and while the bank has to sensitivity test a 2-point spread on our operating expenses, and then all of a sudden it continues to go up, and we get to a point that we can't close because we don't have the proceeds, and then we get pushed into going to HUD financing, and even HUD financing at this time is still a struggle. So,
but it takes forever to close it.
It does, a year.
Yep.
Great. Well, on that note, I have a challenging question that I don't think anyone's going to want to answer, but I'm challenging you guys to give me a yes or no answer, and then I'll give you a chance to back up what you say. But
now you realize we're media trained, so we can answer whatever the hell we want.
Fair enough. But, let's see. Are we in a recession?
Maybe.
I'm saying yes.
I'd say it depends on what definition we're going to use.
Yeah.
So,
media trained. We answer what we wanted to answer.
Great. Well, I guess we'll start with what definition would you want to use, and what are you thinking about when you're trying to
think back to my time in school? I would say that over two quarters we're going down, but I think this third quarter we're projecting the GDP to go up. But I would say if you think about what the equation for what GDP is, okay, and this is something I encourage, right, for anybody going into this profession or even going into any profession. I think look at the data yourselves, try to think, what does this mean? Okay, so I think about what is the calculation for GDP. It's private investment plus private spending plus government spending, government investing, plus the net difference between exports, okay? So spending from the private sector can't go up. And with the inflation market, until we start seeing inflation come, I don't see how it's going up. Investment is down. So then spending is down. Investment, I think, will be down because interest rates. Okay, so private investment and spending is going to be down. So that's downward pressure on GDP now. Now, we just went through an election cycle, so I do think that there's some, certainty that the government, I don't think the government's going to stop investing. They just passed, the infrastructure bill. There's going to be government spending. We know that money is coming, and it's going to be a lot. So maybe it equals out. But then the exports. So when we talk about trying to keep in touch and trying to understand all the different capital markets and what's going on, if everybody's been paying attention, the value of the dollar lately has been skyrocketing compared to Europe, compared to every other currency around the globe. Well, that's going to drive our exports down. That's going to drive imports up. So when that happens, there's more pressure pushing the GDP. I think we're maybe a couple of things away from kind of GDP, maybe another quarter from dropping. And the last thing I would say, one of the drivers of what this new definition of GDP was when there was this argument, is GDP going down or is it a recession, was jobs. And no, jobs have been getting added. Well, this is the first time I've seen FedEx cutting jobs before Christmas holidays, 10,000 jobs getting cut. We see Amazon cutting 20,000 jobs. You see all these companies that are cutting. Everybody cutting.
Twitter, yep.
And that eventually is going to have a significant, ripple effect. So, are we in a recession? I don't know. Are we headed to a recession? I would happen to believe with some of the kind of larger outfits out there that we're heading still into one.
Yeah. So I'm going to say we're in it. I don't know on the line, but what he said was perfect. The only thing I would add is we can continue to, the government can increase the interest rates. Fine, it's going to stop spending and some other things. However, then all the people who could spend are losing their job right before Christmas, right? So that's going to put a hit on biggest sale time of the year, starting Black Friday tomorrow, and all these people have their pink slips, right? But even if they did have money and we don't have access to the things that we rely on China for, we still got some issues. And so it's not just the rates, it's all these other things happening quickly and at the same time, right? Meaning the multitude. And so that's why I'm saying what I'm saying.
And I'll answer this as someone who runs a public company. Whether we're in it or not, I get paid to create what I'd call situational readiness. Mm-hmm. So we spend a lot of time saying, if this happens, how are we going to run our company? And there's a lot of different ways we look at that. So whether I believe we're in or not, I've got to run the company in a way based on what I see in front of me. And we spend a lot of time planning to say, if this happens, if we are in a recession, if interest rates at the 10-year get up to 8, what do we do? How do we continue to grow? Because as a public REIT, we're a deal shop. Our job is to grow the company. So whether we're in a recession or not in a recession, guess what our shareholders want me to do?
Give them the money.
They
show them the money.
They want us to grow.
Right.
So we better figure out in these different buckets how we're going to do it, how we're going to do it differently than when we started the company when interest rates were at 3 or 4%.
So given everything that's going on in the market, how are you positioning your portfolios to protect from maybe some, catastrophic or not great outcomes? And, how are you looking forward through through that as well?
I'm going to continue to follow up on what he said. It's not just in this business, because all we do all day is problem solve, quite frankly. It's better to have a plan B and sometimes a plan C, right? Because you just don't know, and you may not even have it fully baked, but you should have thought through enough of, oh, I have these potential options, because what I know are two things. One, the calmest one in the room is going to lead you out of the crisis, whatever crisis you see. And you're calmer when you thought through things and say, oh, I have this thing to try or this thing to try before I start, really getting jumpy inside. And so let that guide you a little bit. But for me, on what we're doing with real estate, we're planning. We know it's going to take some time for our particular project at the River District. We have to do a lot of infrastructure work. So that's going to probably increase that construction cost a little bit. However, it gives us a little gap in time. We're still planning all the projects, but we can sort of put a little slack in maybe the start date, because we have all this, in infrastructure, we're putting new roads, we're putting new traffic, sewer drainage, fiber. I'm going to get to that tech question, but fiber is really important. And so that gives us a little stack on, before we go vertical.
I would go back to the situational readiness a little bit. For 10 years, the money was so cheap. We knew this time was coming. I think there was a catalyst with COVID and things kind of getting out of hand. But, as a company, we were anticipating rates going up. As a company, one, we've been looking at kind of lowering our leverage on projects. One, because we want to, and we think we can move quicker. We've kept cash to be able to do that. Two, because banks aren't lending as much anyway at this point, so I think we're forced into that scenario. Two, we're looking at different financing tools. Some that we had meetings, year or two ago. Hey, this is an interesting concept, but there's really not a need for us to explore this right now or do this for this project. But at this point, we're using different financing tools that we hadn't used facilities in the past. The other thing that we're doing is strategic partnerships. So I think we are working with other developers, other tenants, and in fact we took a press pause on all of our assets, and we looked at them and said, look, everything we may have spent $1 million to date on getting this project entitled and getting it ready, but those are sunk costs. Does it make sense moving forward for us to pivot and find a better use here? There are different, incentives that are being offered. There's the ARPA, legislation that came out, and a lot of, local governments are actually willing to put grants towards projects for certain uses. So we're exploring those. I mean, they're just different things that we're doing as a company. And the last thing I would say, for us, we've really been focused on this overlap with historic tax credits. But a historic tax credit project can be very complex, can take, a lot of time. We're looking into some horizontal developments, so taking dirt and actually phasing projects. So to do a $60 million project and get it all financed at once, banks are having a hard time financing that. But maybe, doing a $60 million project, but we're phasing it. So it's only a $10 million, $10 million, $10 million. We continue executing on phases, and those are things that we're working on as well.
What we're doing is, you got to be very careful with your underwriting. But our business, we're spread investors. So we're very clear on what our cost of capital is. I joke with my CFO like every day. We should look at it every day. But when we do a deal, we historically have gone out and raised, we announce the deal, we go raise debt and equity that day. The other day, we're talking about different ways to finance. We saw an opportunity, amazingly this happened, where our equity was trading better than our debt. And we did a block trade and raised $580 million in one day, which is not a way of what we usually do. We usually wait for a deal and then go out and do this. But we've changed a little bit of strategy to say, hey, there could be some opportunities. We have over $4 billion liquidity right now. There could be some unique opportunities during this unrest. So we have been talking about the negativity of things that are going on are tough. But I think my friends would say, and I'd tell you, during those uncertain times, there are companies that make a lot of money and make very good investments that become experts in certain areas where there's been displacement. And we have ramped up to say, look, cash is important at this time. If there becomes an amazing piece of real estate that we want to own, it'd be nice to have cash, and we've been able to do that. I can't tell you what we're looking at, but I'll tell you there could be some interesting opportunities.
That's called look for distressed sellers, not distressed assets.
Yeah, exactly right.
Yeah, and so before I ask the next question, just to fill everyone in on kind of how interest rates and how the economic pressures, how that relates to pricing and how that might be changing pricing or creating some discounts. I'm curious if you could kind of explain how this may create opportunities. What opportunities are you looking for? And then I mean, in your situation, you probably might be able to use more equity than debt. But with construction, are you also thinking about going with all cash? Or are you thinking about still trying to get construction loans, even if it might be negative leverage and not as powerful as it could be? I'm just curious in terms of what opportunities are there and how are you going to be able to take advantage of them?
I'll start with one point so you all realize this. Sellers' expectations never move as fast as the market. What I mean is, if you are selling an asset today, you are using benchmarks off the past 2 or 3 years and saying, well, I should be getting this, I should be getting this. And I'm quick to say, well, that was at a time when there was 3% money. It's now 7% money. And so what's happening, you'll hear a lot from real estate companies, big and small, that sellers' expectations simply aren't moving towards the reality of how a real estate company like ours would pay for it. So until that happens, you probably won't see as many transactions until there becomes an inflection point. We're seeing that in many of the large capital markets, and I'd be interested to see how you all are seeing it in your markets.
We also have not seen it yet. We are raising funds, particularly right now, to have cash and we're ready to do that. Going back to your question, just in terms of cash versus equity and kind of the capital stack, we're also exploring just all cash projects and getting them completed because we're talking about velocity. If there are projects we can get completed, let's get them completed. And then on the back end, maybe rates have come back down. Going back again, I love the situational readiness kind of thing. I tell the people I work with all the time, our job from every aspect of the project is to eliminate questions. The worst thing that could be is like, hey, have an unanswered question. As long as we can eliminate all the questions and get out all the questions, all unknowns, and we're confident in the project. Right now, it's tough on the financing, but if we have the capital to go, we go. We can get the project completed, and we can refinance it later.
So, in terms of opportunities, what kind of opportunities are you hoping to accomplish? And are you looking for a specific amount of a discount that you're You know, just in terms of like how you may be thinking about it for anyone.
No, I'm really focused. This project's going to take us 10 years, right? To fully, we have over 40 acres, and it's a mix of hotels, apartment buildings, entertainment, cultural, office building, and so, you know, we're going to be busy. So, you know, we're just focusing on just making sure it happens, and you just have to figure it out. You just have to be really creative and poking holes and you know, have the right team. Having the right team. Another thing that's unique about my projects are because they're catalytic, they usually involve public-private partnerships. And what I mean by that is that local, state, and federal government incentives are usually available or required in order to see it to fruition, because you're early, right? And they can't underwrite. So you may say and be totally convinced, market study and all, I'm going to get $3 rents. But because a market doesn't exist, they say I'm only going to give you $2. And so there's a gap there. And so depending on what you're trying to accomplish, we have mixed income housing. That means we're going to take care of people who have some affordability issues, and by doing that, the government may want to be supportive of that, and there are types of incentives that make that available, because you always need affordable housing, period. But when I put affordable housing next to the convention center, why do I say that? Because one of our top industries is hospitality, right? And those workers work hard, but they have income restraints. And so why wouldn't, if it's in our best interest to create opportunities for conventions to come, people to go to casinos, whatever they want to do, right? Entertainment of New Orleans, and not take care of the people that have to help us be successful. So why isn't it a good idea for them to be near their work and walk to work and have some of the same amenities that we can be afforded? And so that's what we're trying to do, to have it where it's a neighborhood everybody can enjoy, especially the people who are helping and are a key part of our successes. So that's our strategy. You know, we're doing everything, we're backing it up, and so there's some partnerships that are available because we're trying to do that.
Let me give you just one example of how the markets have changed, have led to a new strategy at VICI. So we just announced a deal probably about a month ago with a company called Canyon Ranch. I don't know if any of you have heard Canyon Ranch. They're a fitness spa destination resort. We announced that we are going to fund their next development in Austin, Texas. We're going to put up 100% of the money, and on the back end, after they stabilize, we have a call right to buy the real estate. And I only share that in that if I was on this panel 2 years ago and you asked me, do we do development? I'd say no, our cost of capital is not good enough. Everyone can get cheaper cost of capital. The issue today is they couldn't get cheaper cost of capital. So this gave us an opportunity to get money to work 3 years before we usually would. And it gave us a pathway to real estate ownership. So although I don't think anyone likes that interest rates have gone up, it's given a company like us, whose cost of capital has remained fairly stable because our public equity has remained very strong, an opportunity to get into a new business and a new way to get money to work. So that's just one example that when things get bad or hard, there are opportunities for companies. You just need to change your strategy sometimes.
Yeah, and I guess to zoom in a little bit on that, VICI is one of 3 REITs in the S&P 500 that year to date has a positive, return. Like that's I guess being the market by a landslide. I kind of want to zoom in what makes the strategy unique, what makes like the leases that you have unique, and kind of just go into why that may be the case.
Thanks for the plug. Yeah, it's VICI. We're traded on the New York Stock Exchange. You are correct. We are
And that's NFA, no financial advice.
That's exactly. But no, you're right. We have been, this year has been a very good year for us. You are correct. Our shareholders have been very supportive. We are the #1 performing REIT in the S&P 500. And you're asking why? A little bit is it's taken us 5 years to prove out what was going on. And back to the question I answered regarding our tenants, right? What had to be proven out is that the tenant's business was durable through all cycles. And our tenants reinvented their business during COVID. Give you an example. So Caesars, which is one of our largest tenants, is running their businesses 800 basis point higher in margin. 800 basis points. I worked in the casino business for 23 years. I didn't increase margin by 800 basis points. So instead of sitting around when the business was closed, we had some tenants go and reinvent their business that made them more profitable. And so what has happened is institutional investors are seeing this opportunity to invest in real estate in businesses, our tenants' businesses that are very strong. And there's still opportunity for our cap rate to compress. Meaning, does this make any sense? I'll just give you an example. We bought the Venetian. Anyone been in the Venetian in Las Vegas? Okay. It's the largest hotel in the world. There's 7,000 rooms. It's the largest private convention center in the world. It's got over 14 million square feet of real estate. We bought it for a 6.25 cap 2 years ago. If you were to go buy a Pizza Hut in the middle of Iowa, you'd probably pay a 5 cap for that. Does that make sense to any of you in this room? You can buy the world's largest hotel. It's going to generate more than $500 million of cash. It has diversity of revenues: casino, hotel, convention, food and beverage, spa. I can go on and on. Retail, sold for a 6.25 cap. Now let me continue why there's this opportunity, because you'll love this because you said retail. 7 years ago, the retail inside the Venetian was sold separately. It's called the Canal Shops. It was sold for a 4 cap. So, excuse my language, the good shit was sold for a 6.25 cap, the casino, the hotel, the food and beverage, and the tough business, retail, was sold for a 4 cap inside the same building. So I'm telling you, you're asking why we perform, is we're telling this story that the real estate and the business is completely mispriced. And that there is a tremendous amount of opportunity for cap rates to continue to compress over this time. Now, that could be tough with me buying things if people hear my speech and say, well, Payne's out there saying things should be cheaper than 6 cap, right? It makes it harder to buy. But a little bit of, that's a long way of saying what has been taking place, why are you holding up when others are not? That's part of the story that we're telling, is there's opportunity to continue to grow, and we think that there's been some mispricing in the market.
Yeah, and it goes back to that philosophy on the recession. He doesn't think it's hit the bottom yet, so he's waiting with his money on the ready. Mm-hmm. And I'm worried about, sort of the other side of it.
Yep. Yeah. And we both would be described as we're in the real estate business.
Yeah.
Right? And we're thinking about different things at different times and different sizes and different locations and where we're going to do it and all those things.
Right.
That's what makes the industry very interesting.
And it's very interesting because your project is going to expand past any length of a market cycle.
Exactly.
It's pretty interesting. It's really hard to predict what's going to happen in the future, but I guess that's a good time to ask. No one has a crystal ball. That would be amazing. I think we'd all be the best real estate investors in the world if we did. But does anyone have any predictions of what's going to happen over the next 12, maybe 18 months with interest rates, maybe with inflation, but generally with the real estate industry?
Yeah, I can't really predict, but I'm going to tell you what I have my optimism for my neighborhood, right? Besides, real estate's a location thing, having a key location. Guess what I have? Ocean going, river going, cruises. I have Mardi Gras World. That's creates some things. I have the convention center that's now back in business and people are growing. I'm at the intersection of, basically the French Quarter, the warehouse district, where everybody who's coming to the city is hanging out. And I'm also that sort of back-end corridor for everybody who goes uptown or the back way to Metairie, right? They're doing Chapatulas some kind of way. So that means I have eyeballs and traffic counts that are running back and forth next to where I'm going to be and walking a lot. So all of those things means I'm creating a demand generator, but I have a lot of demand generators all around me that are going to have eyeballs on all of the things that I'm doing, and that gives me optimism.
That's a great project, and it's going to be, talk about optimism, it's going to be transformative for the city, that project will be. Bring in some optimism to it as well. I think we're in for 12, 15, 18 months of just some tough times, just trying to get projects off the ground. I think there are going to be, in that time, though, I think in the next probably 6 to 12 months, we're going to start seeing some, distressed sellers and distressed projects that need to be saved. And I think there are going to be opportunities across the board for a number of people to, take projects and actually come in and kind of, be the hero, come in and fix projects or salvage them or do something interesting with them. And I do think that over time we're going to see the cap rates start coming back down. Right now, we're seeing things all over the board. There's a lot of volatility, but I do think that people are, and looking at it from an investment perspective, we're going to make a lot of money over the next 24 months. And I do think, one of the questions we're going to get into, I think there are going to be opportunities for people like in this room, to get involved in some of these companies, because there is going to be opportunity. Understanding over the next 12, 15 months, it's going to be tough, but I think on the back end of that, I think it's going to be great.
Great. And
let me say one more thing. In down markets, right, people build.
That's right.
And that's exactly what his companies were doing. They were, being strategic, and so when everything came back, they had great returns. And so always remember that. That's the time to keep your head down and just be creative and keep doing great things.
What did Churchill say? Never let a good crisis go to waste. And I think that great operators do that. So it's easy to be successful during great times.
Yep.
It's during these unusual, volatile times where you find the best operators, and that's how we think about where, great operators make our real estate look good, and so that's how we think about it.
Great. And so, I guess moving forward past this volatile time, kind of looking forward at the future, I guess starting with Tara, but what is technology? How is technology becoming more significant in real estate? And I guess you could even give us a broader perspective, given your other endeavors, kind of talk about how,
Sure, and I'm going to include him in or one of his tenants in my conversation. So the first thing is real estate, like maritime, like healthcare, like music, some other things have been slow to the party, right? But during the last several years, it's been really picking up. And when you think about technology in real estate, it goes from, I'm going to call horizontal to all the verticals, right? So what do I mean by that? I mean that everybody's got a phone, a little computer that they do a lot of things on, and guess what? That's power, right? That's taking power. You need fiber. You need certain types of fiber. And so where I am right now is we don't all have 5G, but we need 6G. And why am I saying that? Because let's say you work in an office building, you shop at the retail tenants, you are in the hotel, everything in my district, right? You're going to be looking in a mirror, buying things, trying things on. You got robots this all happens today. You got robots delivering you food. When you do Uber, here comes the robot. You have autonomous vehicles. You have drones. All of this stuff is already happening in different parts of the country, sometimes world. All of that requires power. And so if you're not laying the foundation of fiber in your real estate, you're going to have a challenge. Healthcare, they're doing all kinds of things. So you're doing that from home. You need fiber. You need to be fast. You don't like when your internet's not working, and quickly. So that's one thing to think about. And then from the operational side, you can look up this company called Fifth Wall. And what happened? A lot of the big boys, MGM, the related companies, Hilton, Starwood, all these different Toll Brothers, they said, you know what? Let's all chip in our money into this venture capital fund, and we're going to focus on real estate. And guess what we're going to get as the LPs, limited partners? We're going to get first access to the tech. And we're going to be able to try it out before everybody else. It's about 100 LPs or companies. And so all of those things, they've been doing this since 2016. And so they have been able to kind of have a leg up on all types of tech. And it goes everything from risk management on your construction site, just managing your construction site, to, you know, there's a local, I'm going to give you two local companies, Tulane grads. It's a company called Rent Check. If any of you have ever rented an apartment, I'm sure you have, what if you had the opportunity to walk through and do a self-inspection in video, right? All of the current conditions, so that when you move out, you get 100% of your deposit back. You don't want to have a fight on the deposit that this was broken. No, it was broken when I got there. You have video evidence. And so it's a platform that allows you to do it when you move in, so you can do it. Video before, video after, give me my money back, right? They have, you know, it's just, you can do investments. There's another big company called Cadre, and what you can do is it's just an investment platform where you can find real estate opportunities. So anyway, what I'm getting to is we usually didn't have all of those things, and it's slowly coming into fruition to help with management, but also because we're being forced, because people like to operate from that computer in their pocket.
Yeah, and I guess just to add a layer to this, Fifth Wall's latest fund was $500 million for climate tech and climate prop tech.
Yeah.
So I want to know, maybe technology-wise, how's that playing into your business as well?
Are you saying that in your lending for any requirements with equity in debt?
Yeah. Look, if you're going to go work for a public company, you better understand ESG.
Yeah.
I mean, it's as simple as that. And look, we're a triple net lease REIT, so we don't do anything really. Right? We don't operate anything, but we have tenants that we get held accountable for taking care of our buildings. And the technology that's happening on, you know, from the ESG side on solar and water in particular in Las Vegas is really magnificent, and technology will continue to play a huge part of that.
Yeah, we haven't yet, but one thing that we've done, and looking at kind of our offerings to our tenants currently, is, you know, all-inclusive packages. So their rent includes, you know, Wi-Fi, which will be run through fiber. You know, I think we've taken out all cable through projects. Everything's Cat 6, everything's high speed. And so those are things that I think tenants are starting to expect, or at least, you know, they're definitely differentiators that we're able to provide to our tenants that you know, other people want.
Yeah, we're having lenders that actually require it as well, but we want to as well, because just think about this. What if a pipe is leaking underground in our district? Well, if we had sensors on them and we had sort of an operating dashboard, we'd be able to troubleshoot and know exactly where that was and minimize the damage. What if we have large events, which we plan on having, and guess what? I needed to change the traffic light patterns on my own so that traffic could move a little more efficiently, as opposed to the regular cycle when it was, you know, typical during the day. Well, with a software platform, we can do that. And then within the building, we have all types of opportunities for, you know, from the key swabs to, which is going to be different platforms, to just management of your AC systems or whatever, just solar, you know, how you're storing everything. You know, we may be able to generate electricity from the river water.
Yeah, so yeah, it's very
It's just
incredible.
it's a span of things.
Yeah, there's probably a lot more. Well, I want to open up the floor to questions, but the last question before we get into that is, I'd like to hear, what advice do you have for people in this room for creating a career or a life that they could be proud of?
You want to start, man?
Sure, I'll start.
I got something, but
Yeah.
I've been talking.
So, I guess in this industry, talking about wanting to be proud of it, I think I actually go back and read my entrance essay to the school from time to time, give me a little bit of perspective. But if you're in this industry, you really are affecting people's lives. I had actually a conversation or a meeting last week with a tenant who was upset that there was water leaking through a window during a rainstorm. And it was an old historic window that had been replaced, and they wanted 4 months rent returned to them. They wanted to move out of the house, and they had a young baby, and they were really upset. And it reminded me of my essay, and that like you're affecting the way people live, you're affecting the way that what you're providing to people. It's affecting livelihoods. And so I had to take a step back and like, look, you're not getting 4 months rent. In the back of my head, I was thinking that, but I had to be as empathetic, and I was empathetic as I possibly could be. And we worked with them. We actually relocated them to another apartment, and we're able to provide them. We helped them move. We paid for all their moving and things like that. And so I don't want to be corny and say like, oh, find your why, right? I mean, that's one of those things. But I do think that there are a ton of different things that you can get involved in real estate. So I would recommend, first off, while you're in school, you have the opportunity. I would study every aspect from the deal, from site acquisition, site identification, negotiation, through pre-development, understanding drawings, understanding bids, understanding how we go through development, understanding entitlements. I mean, really try to sink yourself in, understand everything. Get through delivery of a project, from, and not just what you're going to be dealing with as a real estate professional, but also what the end users of the building are, and trying to view the real estate through their eyes. And so I can't tell you, how to have a rewarding. I would say find what your passion is in that. I mean, there are so many different, careers and job paths here. Find something that you're passionate about. And if you do find something you're passionate about, just try to make an impact. And try to make sure that you remember that it's affecting people's lives. Whether it's a restaurant that you're doing, I mean, it's affecting the way people are eating. It's affecting the way that, a restaurateur is able to deliver, food and sustenance to people and quality of life. If it's industrial, you're affecting the way that, we're able to receive goods, and, try to do the best that you can. And I think that would be kind of it. Just find one thing that you're interested in, and just try to make sure that you fulfill that. And the last thing I would say is celebrate the small successes. So I think about, in this industry, you can get beat up a lot, at least from the development perspective. And there are a lot of times where you're trying to work things, and it's a 3D puzzle. Putting a project together is a 3D puzzle, and I can guarantee you, no matter what you do in a project, you can have a plan. Like Tara was saying earlier, you better have a plan B, C, and D. And I always say, let's be Marines, let's adapt and overcome, because we're going to have to. But when you finish a project and you're working on 6 other, don't forget to tap everybody on the shoulder. Hey, good job. That was a great job. We're happy we did this one. And you look back on it, and over a course of time, you actually have a portfolio you're building, you're proud of it. So just those are kind of my little tidbits.
Right. So echoing all of that, but also being brave enough where if you're not doing something you like within here, don't be afraid to pivot. Right? Because if you're not feeling good, the other people aren't feeling good either. They may not be saying it, but it's best to be in a place where you feel good about waking up every day, and you're able to learn and thrive. And what's always important for me as well is that whoever has a watch, I know everybody doesn't have it, they use their phone. If I said, can I take one part of this watch and get rid of it, what would it be? Probably say, you need it. That's how you work together. Well, think of that as your team, right? Because it's not an I, we all contributing something. I don't care where you are in the map, but you're contributing something, and always remember that. And that's sort of the pat on the back, is that you can't lift yourself alone. Somebody's always there to help execute whatever the overall vision is. And allow people to have a voice.
On a few things, less about real estate. The father of 3 daughters around, they're all around your age. Number one thing I say is run your own race. Don't run your parents' race. Run your race. See this? Put it down at times. People are going to graduate this next year, and you're going to see someone go on to Wall Street and be like, oh, they're so successful and this and that. Run your own race. You're going to all move at different times, in different paces, It's your race. It's no one else's. No one else is keeping time except yourself. So that's critically important as you start your career. I find that your generation loves to look at this and see that only the good stuff is being put on this, and they say so-and-so's better than I. They're 2 years ahead of me. They've accomplished. I'm way behind. What are you behind? You got a lifetime. Look, I was a casino executive for 23 years. I'm sitting in front of you as a real estate person. The second one is live with integrity and lead by example. It's all you got. You're in a deal, you're putting on deals, and you don't live with your have integrity, you won't do another deal. Third thing is a book by Ron Shapiro called The Power of Nice. There will be people who will tell you, oh, you need to be tougher. Being tough and nice, they can work together. Think about the people who call you. I know your generation doesn't necessarily call or text you. And you go, ah. And then think of the people that are really nice and you like to be around. That's the same way in business. I'm not saying we've been able to grow our company as fast as we have because we're nice, but people like to do business with us. The power of nice. And then the final one is be on time. It is respectful for the people you do business with. People who walk in the door and say, oh, I'm sorry, I'm busy. Well, who the hell is not busy, right? And what I find is if you're on time, no matter if you're in real estate or not, you actually stay to a schedule. And then you can have balance in life because you've accomplished and you've stayed on that schedule, and then you can do other things than just work. So those are the four. They didn't have all to do with real estate, but it's important for groups like this that are thinking about what they want to do.
Of course. Well, I appreciate that, and that's definitely going to ruminate on that later, as I hope everyone does. But I'd like to open up the floor for questions. Does anyone have any questions for these leaders in front of us today?
Hi, I'm Alina. I'm a freshman, and I'm from San Francisco, where there's a lot of talk about like affordable housing and thinking about like gentrification. So my question is, how do you sort of set the boundary between redeveloping and gentrification, and how is that relevant here? Because I know a lot about like my own area, but I'm a little unfamiliar as to how that is here.
So most of my projects are pieces of property that don't have anything. So they're buildings that have sat vacant for 10 years or sometimes more, or like this land where nothing's there. And so we build affordability within it. So you could be in what someone might describe as a neighborhood that might look gentrified, you know, even though it's new. But what you do is you have protections in place because so that those people, you know, who aren't as don't have all the means are able to enjoy the space as well, but it's protected, right? Because they have periods where it's 30 years and it can't, the rents are fixed or whatever the situation is. Usually that is how, and then a lot, just part two on mine, you know, I have the coolness factor, and so why do I say that? That's in my tagline, is because I say artists are the arbiters of cool. So when you see all the new neighborhoods, it's usually kickstarted by some art, right? Some form. It could be food. If I told you that there was this hot restaurant, whatever your favorite food is, I don't care where it is, you're going. If that's what you, and so that helps people group together, just like the artists in Soho and other neighborhoods. And so what I'm getting to is they help make it cool. They should have an opportunity to stay. So.
This is not my business, but I'd say cities that make it difficult to develop, developers will move to other cities to grow. And I do think that's going to be really interesting from your hometown. I think San Francisco is one of the large urban cores of America that probably was impacted the most during COVID. And it's a real interesting question of how is that city going to come back to the level. You've seen a lot of conventions move out of that city and go to Las Vegas. I mean, I happen to know that because that's the business that our tenants are in. And but it's a really good question, and one that you're going to see, you know, for the next 5-10 years. If how is that city going to kind of rebuild itself and come back to life? Because there have been areas of the city that really were closed down and have not come back.
I'll just kind of echo both things. I mean, I do think when you're talking about gentrification and how it's a tightrope, even as a developer, that you're walking and, or you're thinking as being an urban planner, or you're thinking about just neighborhoods and how you want to live. I mean, like the last thing I think any of us want to do is to move people out of a neighborhood just because they can't afford it. And you see it, you see it in New Orleans a lot across different neighborhoods. And I say that because you've had a lot of people who have moved here, from other cities and found the cost of living here so much more affordable, even though, when you're comparing to Austin or San Francisco, Chicago, New York, and they moved to New Orleans, like, oh, it's so cheap. And so I think it's happened across multiple neighborhoods. And so on the flip side, right, if there are blighted properties, if there are properties where you just have vacant lots, it's also a question of, if we don't develop them and they sit here, I mean, we have issues that can come because of, just blight brings crime, things like that. A question that, I actually, with the mayor, we would butt heads all the time, because if we ever would get into a situation where we were told you can't develop this, and say, look, we're trying to work on affordability, and there's a supply-demand component as well. And I do agree on the mixed-use legislation in terms of, LIHTCs and really trying to encourage, and I think the city should try to incentivize more mixed-use development. And I know they've tried in terms of providing bonuses and things like that to allow developers to come in and provide, incentivize low-income housing. It's a tough situation though, and it's one, I was on like a national panel one time at a conference, and like really, there was somebody who was combative when they asked that question, and it's never.
What you have to understand is, across the country, none of the affordable housing works. Because if it costs $300,000 to build an apartment, like say one apartment unit, regardless of who lives in there, it's $300,000, right? And so if somebody can only pay half of that, where's the other $150,000 coming from? And so everybody's looking for that assistance, which also makes it difficult, which is also part of the problem why we don't have enough units, because all of them require some type of subsidy. And it's a challenge, but you just have to keep working at it.
That's right.
Yeah. Hi, I'm Zach. I'm a senior at Tulane from Stamford, Connecticut. You guys briefly touched upon ESG and ESG implications and awareness. I just wanted to understand your thoughts about the trends in green development and integrating buildings, especially residential buildings, with vegetation, and how important it is to prioritize green development in sustainable architecture. Could you guys touch upon that at all, and what you see as the trend in that space?
I'm not sure if you have it, because he's not necessarily developing. But, so I haven't necessarily done vegetation, but even in Blue Plate, we have solar panels on the roof. I have all types, from the plumbing to the electrical to sound attenuation, really creative materials to minimize electrical bills, water, everything, not just for the tenants, but also for the landlord, right? And we're trying to implement, we are implementing a variety of things and going through some of that exercise right now, both within the district, like how we do stormwater management and some other practices, but nothing that's specific to having, like a green roof or something like that. I haven't done it before.
From our standpoint, I mean, we haven't done the green roofs or green screens on properties, but it goes back to kind of trying to build the most efficient properties as possible, and we do that. Every design meeting that we have is focused on making sure that we can do that, and there are different reasons to do it for doing that. But I would say, from our standpoint, I mean, limiting the operating expenses and making sure the building is operating as efficiently as possible is number one, and for us, I mean, the fact that it is a benefit to the environment is number two. And I would also say just sustainability of materials and using materials that are responsible, or reusing materials when you can, is something that we're very focused on.
And we do it with converting the old buildings. That starts there, instead of tearing them down.
Excellent. Well, we're running up on time, so that'll be it for questions. Can we all give a round of applause to everyone?
time.
And hope that you guys begin your career, start to navigate your journey through the industry, that you take all the advice and insight that we've gotten from these professionals today, take that to heart, and wish you best of luck, and let's do it.
Happy Thanksgiving.
You did a great job.